route. Redfin's been touted in the past as one of the disruptors in the market, and yet they still have less than 1% market share and declining over the first 3 months of this year. So if you're publicly communicating to your investors and the public markets that you're a disruptor and your market share is declining, along with your revenue, your profit, your gross margin, that's a rough earnings report. One bright spot, in the report is that despite the decline in transactions, the revenue per transaction experienced a slight uptick, increasing 3.26% year over year to $11,556. Now, I got to imagine, Bruce, that little piece of good news is due to prices still increasing over last year and holding now, as well as we reported this last week, the average commission actually going up. One silver lining piece of this story for Redfin, the revenue per transaction slight uptick. So I think they should probably take
9%. Schneider on the call said companies' losses were meaningfully impacted by new legal costs associated with the ongoing antitrust lawsuit that was newly certified in March as a class action case. Again, we've talked about this on our news reports. This is meaningful, right? I mean, they're spending millions and millions of dollars to go fight this, right? As are all the other companies and NAR who have been named in this particular lawsuit. What that led to was that the company actually spent nearly half its remaining cash in the first quarter of this year. So they ended the period with $122 million in cash and cash equivalents. And by the way, at the end of 2022, they had $214 million in cash.
That's actually the most disturbing part of the story to me, because it's been said that cash is like oxygen. Once you're out, you're dead. And to burn through half in one quarter is quite concerning, given the fact that you're, losing money like crazy, and there's probably not a lot of short-term opportunity to rebuild some of that cash without going and raising it. Once again, you have a very optimistic tone from Zillow CEO Rich Barton, saying we're starting to see our investments pay off with first quarter financial results that outperformed the top end of our outlook. And that's a really nice way of saying that. Even though they were really crappy, they were not as crappy as we thought they might have been. I know I'm laughing here and it's funny to me, but I do really respect and appreciate the ability of some of these folks to remain optimistic. They need to do that for their shareholders and the people that work there. Certainly, they still have a strong attachment to the vision of where they're going. So I appreciate that.
Yeah, they can get pretty creative with their use of words. I agree. What was interesting was Zillow's mortgage business took the biggest hit, with revenue falling 43% year over year in the first quarter. Revenue from Zillow's residential segment, which includes the Premier Agent lead generation program, fell 14% to $361 million. I want to be clear to our listeners here, Chase, and that is that $361 million was commission dollars paid to agents who then had to hand that money over to Zillow as a part of that Premier Agent program.
Like a really strong job market in part indicates still a really strong underlying economy, which might indicate that our friends at the Federal Reserve may not be done hiking interest rates quite yet, which is what the article spells out, Bruce. And that's something that people have been hoping that maybe they were done for a lot of obvious reasons regarding the cost of money. And yet they may not be, because if the economy is still roaring in certain key pieces and they can't get a hold of inflation, that's one of their primary levers, as we've always talked about, right?
Yep. And we know that it's sort of a two-edged sword, because, they need to slow the economy down. And every time they do this, they're putting more and more of these regional banks at risk, right? We're still seeing turmoil in the banking sector. How that impacts the Fed's decisions is still yet to be seen. What I thought was really interesting about this, Chase, so not only did we increase the number of job openings, but unemployment fell slightly from 3.5% down to 3.4%. And by the way, that is the lowest unemployment rate since 1953. Like you said, the signals are mixed. We're trying to slow this economy down, and yet we've got, for us, generationally unheard of unemployment rates, which is still driving the economy.